Okay, let's unpack this. Have you ever heard of a financial strategy called, well, Nickelback?
Hey, probably not in this context.
Right, or how about Pennywise? It
Mhm.
definitely makes you think of, certain rock bands, not not sophisticated finance.
Exactly. But that's where we're going today.
Yeah, we're diving into how a fund handles this huge volume of options trading. We're talking what, up to 20,000 short put contracts a year?
That kind of scale, yeah.
And they use these automated exit strategies with these, well, memorable names. So the mission for you listening to this deep dive, it's basically the shortcut to getting smart about automated financial decisions, specifically in options. We want to uncover how this kind of precision, these rules-based systems, really translates into efficiency and profit.
And it's fascinating because the challenge they solved was pretty significant. I mean, think about managing thousands of positions simultaneously.
Yeah, that sounds like a nightmare.
It can be. Yeah. You've got all these inherent problems. Trying to figure out the perfect time to exit, avoiding paying commissions on tiny amounts, preventing operational drag, simple mistakes.
And you mentioned covered versus uncovered positions. That adds another layer, right?
Absolutely critical. Covered positions backed by collateral or shares are much lower risk than uncovered ones. Before automation, managing exits consistently across both types, especially at volume, really tough. Gains could just get eroded.
Okay.
So the solution was, well, pretty elegant, actually. These two automated protocols, Nickelback, Pennywise, designed purely to optimize exits based on whether a position's covered, its DTE days to expiration, and fundamentally cost efficiency.
Right. So the big picture goals here, what does this automation actually achieve?
Well, several key things.
First is maximizing returns, I assume. Exiting early, low cost.
Exactly. Capture the profit efficiently.
Yeah.
Second, slashing those unnecessary commission costs and just the general operational hassle.
Makes sense. And risk management.
Big one. It improves risk management by closing positions while they still have enough time value, enough DTE, reducing that exposure proactively.
Okay.
And, maybe counterintuitively, it also allows certain low-risk positions to just expire worthless.
Yeah.
When that's actually the most profitable or cost-effective move.
Ah, interesting. It's like building this really fine-tuned machine.
Sort of, yeah. Self-correcting in a way.
So how do they actually work? Let's get into the rules, the logic, starting with Nickelback.
Right. Nickelback, this is the default. It's specifically for the uncovered short puts.
Uncovered. Got it.
And its main job is simple. Close these positions efficiently, reduce that market exposure quickly.
Okay, and the logic, how does it do that?
It's precise. It runs every week, Sunday, and it automatically places a good till canceled order, a GTC buy to close order.
GTC. Okay. At what price?
Just 5 cents, $0.05.
5 cents. So really aiming low.
The goal is to exit when there's hardly any premium left. Basically, it ends up closing positions, on average, about 18 days earlier than their actual expiration date.
Just getting out clean, minimizing risk on those uncovered ones.
Exactly.
Okay, so then Pennywise, that must be the contrast.
It is. If Nickelback handles the uncovered, Pennywise is specifically for the covered short puts.
Covered, right. So lower risk profile.
Much lower. The trigger for Pennywise is when a short put actually becomes covered, either by cash collateral or assigned shares. The downside risk is minimal at that point.
So what happens then? Does it use the same GTC idea?
It does, but first, if there happens to be a Nickelback order already on that position.
It cancels that one.
Instantly cancels the 5-cent Nickelback order. Then it places its own GTC buy to close order, but way lower, just 1 cent, $0.01.
Wow. Okay, 1 penny. Why so low?
Because with covered positions, the risk is negligible. The preference is to let it run longer, capture almost all the premium, and only close it out for the absolute minimum cost possible. Maximize the return when risk isn't the main driver.
That makes perfect sense. Different risk, different exit price point.
Precisely. But there's another layer here that ties them both together.
Okay.
The DTE rule. Days to expiration. And this is crucial for the cost-saving aspect.
Right, you mentioned DTE earlier. Does this apply to both Nickelback and Pennywise orders?
Yes, absolutely. It applies to all GTC buy-to-close orders placed by the system.
So how does it work? What's the rule?
Okay, so during that same Sunday automation run, the system checks every single open GTC order. And if any of those orders have less than 10 days until the option expires, BTE less than 10,
Yeah.
the system automatically cancels that GTC order. Poof. gone.
It cancels it. So it doesn't even try to fill the 5-cent or 1-cent order anymore?
Right. It just cancels the order entirely.
Why? What's the thinking there? Why not try and collect that last nickel or penny?
This is where the real, financial common sense comes in. It's pure cost efficiency.
Okay.
Think about it. Brokerage commissions aren't zero, right?
Mm.
Closing an options contract might cost, say, $1,
Mm-hmm.
maybe even up to $3, depending on the broker and fees.
Right. The transaction costs.
Exactly. So why would you spend $1 to $3 in commissions just to save or collect a final 0.1 cents or 0.5 cents?
Ah, okay. The cost of closing is more than the remaining value.
Precisely. It's just not worth it. The system recognizes that point of diminishing returns. So assuming the risk of assignment is acceptable for that position.
Which it likely is if it's near worthless or covered.
Right. It just leaves the position open to expire worthless.
Mm-hmm.
For free. It avoids spending money to make, less money, or even lose money on the transaction itself.
That's actually brilliant in its simplicity, just letting tiny positions die off naturally to avoid fees.
It demonstrates really extreme cost efficiency in practice.
Okay, so can you just walk us through that whole weekly process again, step by step, every Sunday?
Sure. So Sunday rolls around. Step 1,
Yeah.
the system evaluates all the open and short positions.
Okay.
Step 2, it determines for each one, is it covered or uncovered? That's the key decision point.
Right.
Step 3, apply the strategy if it's covered. Cancel any Nickelback order that might exist, then place a Pennywise GTC order at 1 cent
Got it.
if it's uncovered. Place a Nickelback GTC order at 5 cents. Or, if one already exists, just leave it.
Makes sense.
Step 4, the final check. Scan all active GTC buy-to-close orders. Any order where the DTE is less than 10 days, cancel it. Let it ride towards expiration.
Clean, logical, sequential. And the benefits of doing all this automatically, they must be pretty substantial. It's not just about saving a few bucks on commissions here and there, is it?
Oh, not at all. The strategic impact is much broader. Think about return optimization.
Yeah.
You're preserving profits by either getting out early near maximum gain or by not paying to close something that's about to expire worthless anyway.
Yeah.
You capture more of the potential premium.
Right. And the cost efficiency we talked about.
Huge. Eliminating that wasteful commission spending, especially near expiration, adds up significantly over 20,000 contracts a year. It hits the bottom line directly.
I can imagine. What about risk management?
It's much tighter. Uncovered puts, the riskier ones, get systematically targeted for early closure via Nickelback. Covered puts are confirmed as low risk before Pennywise even lets them run longer for just a penny exit. It stratifies the risk automatically.
And the sheer scale. Handling 20,000 plus options a year.
That's the operational scalability. This whole process is fully automated, minimal human oversight needed for these routine exits. It frees up traders to focus on, more complex analysis and trade entry, not tedious exit monitoring.
Removes a massive bottleneck.
Exactly. And a side benefit, it just leads to a cleaner trade book, fewer tiny near-expiration orders cluttering up the system, easier to manage overall.
It really sounds incredibly efficient. But I have to ask, with something this automated, this rules-based, does it ever miss something? In really crazy market conditions, is there ever a time where maybe human judgment would override the logic? Or is the system just better for these specific tasks?
That's a really good point. And it touches on the constant debate in automated trading. For these particular exit rules focused on very low remaining premium and DTE, the automation's consistency is almost always superior to human discretion, especially at this volume.
Oh.
The nuance these rules are designed to catch is primarily about cost and efficiency near the end of a trade's life. That's where the rules excel. Human judgment is vital for setting up the initial trade, managing overall portfolio risk, reacting to major unexpected news, but for closing out these low-value positions. The automation avoids emotional decisions or simple oversight. Its consistency is the risk mitigation strategy here.
That makes sense. Define the narrow task, automate it perfectly.
Pretty much.
It's still amazing when you consider the level of precision, the efficiency, the cold logic driving it all.
Yeah.
And then you remember the names.
Yeah. Nickelback. Pennywise.
It's just wonderfully ironic, isn't it? These super precise, rules-driven financial engines named after bands maybe known more for, let's say, mass appeal than complex artistry.
Efficient, maybe divisive, but oddly effective at scale.
Exactly. It kind of highlights that in finance, sometimes consistency and volume, executed flawlessly, can be more profitable than maybe, trying to be a critical darling with every single move.
Well said.
Yeah.
And yeah, to sort of wrap it all up, what really stands out is just how ingeniously simple yet effective these automated strategies are.
Hmm.
You know, Nickelback Pennywise, combined with that essential DTE rule,
Yeah.
they're just a fantastic example of how really precise automation can completely transform complex, high-volume operations in finance. You see real gains,
Yeah.
better efficiency, serious cost savings, and much tighter risk management, all from sticking to a few clear, consistently applied rules.
So, thinking about this, what does it mean for you listening? I mean, given the incredible precision and, frankly, the efficiency that systems like this bring to finance, where else could that kind of thinking apply? What other parts of your life, maybe your business, could benefit from a similar, really specific, rules-based approach to making decisions? What really strikes you about the power of defining those precise exit strategies, whether it's in trading or, maybe something else entirely?